what is the difference between stock trading and options trading? And in this video, we're going to explore the differences between the two. Before we get into this a little bit deeper, let's clarify some pretty fundamental terms. What is a stock? Now, a stock is just a type of security that shows ownership in a company. A share is a unit of stock that shows the stockholder's proportion of ownership in that company. Market price, that's just the current price at which an asset or a service can be bought or sold. A premium, and this is an options trading, and this is the price paid by the buyer to the seller to acquire the right that the option gives them. And an expiration date, this is the date on which an options contract becomes invalid and the right to exercise it no longer exists. So, stock trading just involves buying and selling shares of publicly listed companies. And for the majority of us, the goal is pretty straightforward. We're going to buy the stock low and we're going to sell it when it gets high. So if you purchase 100 shares of company X at $10 each and you sell them when the stock reaches $15, well, you just made a profit of $500. Options trading, this offers a different kind of flexibility. And an option is a contract that gives you the right, as the buyer of it, but not the obligation to buy or sell an asset at a predetermined price known as the strike price before a certain date, and that is the expiration date. So here's an example of that. So let's say you think that ABC company, it's trading at $100, is going to increase in value in the next 3 months. So you buy a call option with a strike price of $110, expiring in 3 months, and this costs you $5 a share. Now remember, each contract has 100 shares of stock, so that premium is $500. So if this stock goes to 120, you exercise your option to buy it at $110. You now sell it at the market price of $120. So your profit is $10 a share. Then we're going to subtract the premium that you paid, which was the $5 per share, and not going to account for any commissions or fees. You will walk away from that trade with $500. Now, a put option, let's say you expect stock ABC, it's trading at $50 a share, to fall in the coming months. So you purchase a put option with a strike price of $45, expiring in 6 months for a premium of $3 per share or $300 a contract. So if ABC price drops to $30, you exercise your option to sell at $45. So your profit is $15 per share. We're going to subtract the $3 in premium. So that's $12 per share profit minus any additional costs. But remember, each contract is 100 shares, so it's $1,200. So why would options trading be better than stocks? Well, a few reasons. Leverage. With options, you can control a larger amount of shares with less money compared to buying the actual stock. This is leverage. So controlling 100 shares of a $50 stock might only require $200 in premiums when you're trading options, as opposed to $5,000 for buying the shares outright. There's flexibility. Options will provide you the ability to speculate both on the rise and the fall of stocks. So this means you can make money in a falling market by buying put options instead of borrowing the stock from your broker to short. There is lower risk with potential for higher returns. So when you buy an option, the most that you can ever lose is what you paid for that options contract, the premium that you paid. But the gain, that could be quite large. So there's a big difference between the risk and the reward. And this makes it a very attractive choice for those with a lower risk tolerance. And there's alternatives. There's various strategies out there that can be tailored to meet whatever goals that you have and risk tolerance that you have. We got covered calls, protective puts. These provide income and a hedge against losses. So beyond the basic calls and the puts, there are several advanced option strategies that can meet various investment and trading goals. There's spreads. This just involves buying and selling options of the same class, same expiration, but different strike prices. So A bull spread is used when moderate growth is expected. We have straddles, and this is buying a call and a put option of the same stock, the same strike price, the same expiration date. And this is used when you expect a stock to move significantly, but you're uncertain of the direction of it. We have iron condors, and this is a more advanced strategy, and it involves 4 different options to profit from stocks that move within a certain price range over a period of time. But in this video, I want to keep it very simple and just talk about the differences between stock trading and options trading. So again, stock trading, buying and selling shares of publicly listed companies. Option trading, more flexibility, there's leverage, and there's alternative strategies you can use. These contracts give you a right, but not the obligation, so you don't have to buy or sell an asset at a predetermined price, that's a strike price, before a specific expiration date. So options trading provides opportunities for risk management and potential higher returns compared to stock trading. Makes it a huge addition to any trader's toolkit.